Hey there everyone and welcome back to our channel. My name's Sam and today we'll look into the minds of big investors to understand what drives their decisions. While this concept may seem complex, we'll break it down in a way that's both accessible and practical for your trading strategies. But before we get into all the exciting details, make sure to like this video and subscribe to our channel for more content just like this. Alright, let's get started. Alright, so let's begin by understanding the mindset of big investors. Whether it's Warren Buffett, Ray Dalio, George Soros, Cathie Wood, or Carl Icahn, or any other prominent figure in the financial world. These investors have a unique way of thinking. They don't just look at the surface level, they dig deeper and analyze the market from every angle. One key factor that drives their decisions is long-term value. Big investors aren't looking for a quick profit. Instead, they focus on companies that can grow steadily over time. For example, think about Warren Buffett's investment in Coca-Cola. He didn't just see a popular soft drink, he saw a brand with enduring values, global reach, and a product that people love and will continue to buy for years. Another crucial aspect is risk management. While they do take risks, these risks are calculated. They often employ strategies like diversification, spreading investments across different sectors to minimize exposure to any single risk. It's like not putting all your eggs in one basket. Now let's talk about what influences these big decisions. One major factor is economic indicators. These include things like interest rates, inflation, and employment rates. Big investors keep a close eye on these indicators because they give clues about where the market might be heading. For example, if interest rates are rising, big investors might shift their focus to sectors that tend to perform well in such conditions, like financials. On the flip side, if they see signs of a slowing economy, they might move towards more defensive stocks, those that tend to remain stable during economic downturns, such as utilities or healthcare. Another influence is market sentiment. This is the overall mood of investors, whether they're feeling optimistic or pessimistic about the market. Big investors often look for opportunities where the sentiment doesn't match the fundamentals. For example, during market panics, when prices drop drastically, an experienced investor might see a buying opportunity if they believe the market has overreacted. Let's look at some real-world examples. During the financial crisis of 2008, while many were selling off their assets in fear, some big investors saw an opportunity. Warren Buffett famously invested in Goldman Sachs at the height of the crisis, when others were too scared to touch it. Why? Because he saw a fundamentally strong company that was temporarily undervalued due to market panic. Another example is Ray Dalio, who's known for his principle-based approach to investing. He often talks about the importance of understanding economic cycles. During the COVID-19 pandemic, Dalio's fund made significant adjustments, shifting towards assets that could benefit from the economic stimulus measures being implemented globally. Now let's address a critical aspect of investing: risk. It's something that even the most successful investors must contend with, and no one is completely shielded from the market volatility. This is why effective risk management is essential. The market can be unpredictable, so having a well-thought-out risk management strategy is key. Remember, trading involves significant risk, so it's vital to utilize all available tools and thoroughly research your investments. For example, hedge funds often employ complex strategies like derivatives to protect against potential losses. While you may not be using these advanced techniques, the core idea remains the same. Understand your risk tolerance and have a clear plan in place for those times when the market doesn't go as anticipated. We've looked at how investors focus on long-term value, analyze economic indicators, and navigate market sentiment. We've established that risk management is crucial, and even the best of the best need to be prepared with a solid strategy due to market fluctuations. But who's your favorite popular investor and why? Let us know in the comments down below, and while you're down there, make sure to like this video and subscribe to our channel so you don't miss out on any of our other videos. And since you enjoyed this one, here are 2 more videos you might like. I'll see you next time.